Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk through a little bit of the differences between term and whole life, specifically with the idea of trying to answer the question, which do you need? Do you need term or do you need whole life? And here I intend to kind of talk about it in a way that's a little bit different. Dave Ramsey often, if you ask somebody who is a follower of Dave Ramsey or Dave Ramsey himself, he's got kind of a blanket catch-all, no one needs whole life, everybody should get term. And I think it may be painting with too broad a brush. On the other hand, you might have people who are simply fans of whole life who diminish the value of term. I think the reality is that both of these could potentially be beneficial to certain people in certain situations. It has to be set up correctly, it has to be funded correctly, they have to be carefully tailored to individual needs. But I thought I would just kind of talk through some of these issues. And one way of starting it off would be, think about it as this: term insurance is clearly temporary. Whole life is a species of permanent insurance. So if you have temporary needs, temporary insurance can often fit the bill. If you have permanent needs, permanent insurance is probably going to be more recommended for those. Now this is a slogan. Slogans kind of try and communicate something of importance in a pithy way, but they can be very rough around the edges and they might not speak the entire truth. You might think of the difference between term and whole life in terms of the difference between short-term needs and long-term needs, but even here I think it may fail to capture the full picture. So let me give you some examples and hopefully help to clarify it. So an example of a temporary or short-term need, let's say, might be something like income replacement, mortgage protection, other debt repayment options like credit cards, personal loans, student loans. And here what I have in mind is, if a breadwinner dies, his family or her family is going to require some kind of a death benefit in order to replace the income that was lost from the breadwinner's untimely death. But as the person gets closer to retirement, the amount of time that they have left to work presumably is going to decrease, and if they had good retirement saving strategies in place, then that income replacement becomes even less. Or think about it in terms of a mortgage payment, right? If you have a 30-year mortgage, then at the beginning of the mortgage, maybe you owe $200,000. But 15 years into the mortgage, you're having more of that paid off, and then the idea is as you go towards that year 30, your mortgage is going to decrease until you've got the mortgage paid off. So your mortgage replacement need in terms of insurance is going to decrease as you pay it off. On the other hand, there can be certain permanent insurance needs. And here, the number one item is going to be final expenses. So everybody's going to die, and the only policy essentially that's going to matter to you in terms of being able to pay for that is going to be the policy that is in place when you die. So if you die at life expectancy, let's say somewhere between 76 and 86 years of age, just to be real rough with the numbers, then a term policy almost for sure is not going to be in place at that time. So you're going to have to cover your final expenses some other way. You could cover them out of personal savings, but if you want to try and cover them at a discount or with a coupon, so to speak, then you're going to want to have some kind of permanent policy in place. Now, you might also consider a permanent need as being something like a life insurance retirement plan supplement. And the reason this is going to be permanent is for the long-term idea. You're going to want that to be in place as you put your retirement plans in place, or something like a tax shelter, a legacy plan. All these things you're going to want to have in place when you die. But each of these needs is going to involve different things. So for example, there's going to be a different level of death benefit involved. The amount of money you might have to have for income replacement is going to be quite a bit higher generally if you've got quite a bit of time left to work. It's going to be higher than what your final expenses might be. You might be able to get a final expense policy, that pays out $10,000, whereas you might need $1 million of term insurance in order to cover your income replacement. And so also they're going to include different levels of cash benefit, cash value. So if a policy is a term policy, there's going to be no cash value at all. If it's a permanent policy, it's going to have some kind of cash value component to it. But they're also going to matter and change and be different in terms of how they're funded. So funding strategies are going to vary, and so you might call that your level of premium commitment. The more premium you put in, the higher your death benefit might be, the greater your cash value might be, the shorter the period of time over which it might take for the cash value to accumulate. Various concerns like this. Now, the kind of policy that you're going to prefer will depend on how well that particular kind of policy serves the needs that you have and gives you what you want. So think of it this way. Let's consider 3 different things you might want in a policy. So for example, you might want a lot of death benefit, But another thing might be, again, you might want some cash value to go with that. You also might want a low premium. Well, the way it kind of works is that you're going to have to sacrifice one of these things in order to get the other two. So let's suppose that you need a lot of death benefits. So you just determined you need $2 million to protect your income for your spouse, and then you can choose. Do you want to couple that high death benefit with cash value accumulation, or do you want to couple it with a low premium? So let's say you selected, I want to couple the lot of death benefit with cash value. Well, in that case, you're going to be talking about some kind of a limited pay whole life policy, possibly a universal life, depending on how it's set up, but it's going to have to be very heavily funded. So if you look at it and you kind of get sticker shock looking at the price tag, then you might say, all right, let's change that. Instead of coupling high death benefit with cash value, let's couple it with low premium. Well, that's going to be a paradigmatic term policy situation. You could also do it with some universal life, again, depending on how it's set up. But notice that when you couple high death benefit with low premium, you're going to sacrifice the cash. And when you couple death benefit with cash value, you're going to sacrifice the low premium. And similarly, you can couple cash value and low premium, but then you're going to sacrifice the death benefit. So that's going to be the kind of an application we might expect to see in a final expense situation, possibly some tax situations, but cash value and low premium, that's pretty much going to be your traditional whole life. Now, the way I think of this when you're trying to decide how to fit these products into your portfolio, the way I would say it is, let's consider that you have two different portfolios. First one is going to be the insurance portfolio. So here you're going to have term insurance, you're going to have whole life, you might have some universal life, you might have long-term care policy, you might have disability insurance. Everything in that portfolio, the insurance portfolio, is going to be there for some kind of a traditional use for insurance. So for instance, the term might be used for mortgage protection, debt protection. The whole life might be used for final expenses or estate or legacy planning. The universal life might be there for income replacement or for a key person if you have a business. The long-term care, that's your nursing home insurance, right? The disability, that's going to be there straightforwardly in case you get disabled. In other words, every one of these products is there for some paradigmatic insurance-related purpose, and they're going to be earmarked for that. If you have a whole life policy that is earmarked for your final expenses, you may as well think of it as you put it on a shelf and write final expenses on it. You don't want to touch it, or you are going to leave a gap in your final expense planning, right? So the second portfolio, though, let's call that your retirement portfolio. In that, you're going to have employer-sponsored plans, so that might be 401k, 403b, 457b. You might have a traditional IRA, a Roth IRA, a non-qualified annuity. You might have brokerage account. You might have a CD, money market. And here you might have whole life or universal life insurance. So why does whole life and universal life, why do they show up both in the insurance portfolio and potentially in the retirement portfolio? And the reason is because they have a dual nature to them. So they are able to deliver both a death benefit and a living benefit. So if you're thinking about how the product would fit in your insurance portfolio, we're almost for sure talking about it in terms of death benefit. How much is it going to pay out if you die? So if we need a policy to replace some of your income, then we are going to need that in place when you die, and we're going to be concerned with the death benefit. Or if we're setting up a policy for final expenses, so let's say it's $25,000 policy, $25,000 for final expenses, then we're concerned with it and we think of it as a $25,000 policy. Now, is it going to have some cash value if it's a whole life policy? Yeah. But if you take the cash, you're going to leave that gap in your insurance portfolio because now you don't have a final expense policy. On the other hand, if you've included the policy in your retirement portfolio, then you can feel free to think about the cash available first and foremost, and the death benefit is simply an extra. It's a flourish. In a lot of cases, that's going to be the case. Now, if you're planning for estate and legacy planning, you might think about both of the two of them at the same time. If you're not sure whether your money is going to be live on or leave on money, having it in a life policy can kind of take advantage of both the living benefit and the death benefit. So you might think, if I need the cash, I can take it, and if I don't need the cash, then it's going to be available as a death benefit to my beneficiaries. But if we're thinking of the planning in terms of the retirement, Maybe you're trying to set up a life insurance retirement program or a 7702 plan supplement to other saving strategies, then you're probably going to be first and foremost concerned with just the cash or the living benefit. So how these are actually going to fit in your individual portfolio, or whether they do fit in your portfolio, should be a matter of conversation that you might have with various advisors that you trust, financial planner, insurance agent. I have a video where I talk about the 4 people that you should consult before you plan your retirement or as you are working toward retirement. And essentially, the conversation is going to unfold in terms of which, if any of these products, are going to possibly benefit you. So I can't comment specifically, I can't give you advice. All this has been is for general informational or entertainment purposes. But if you did find something of interest, I ask you please like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you so much.